Hi, everyone. Thanks so much for joining us today for our Ask the Experts webinar. We'll give everyone just a few more seconds to get into the Zoom here. All right. Thanks, everyone, for joining. I think we'll go ahead and get started. We look forward to discussing how to manage working capital in a disruptive and dynamic environment with you all today. I'm MB Henry, a manager in Riveron's Atlanta office. Given the uncertainties in the current economic environment, we will focus on how companies can best position their liquidity and weather any potential downturns in the market. I'll take a moment to introduce our presenters today. Oscar Durham, a managing director in our Dallas office. Greg Carlton, a managing director in our Houston office. Adam Linton, a director in our Washington, D.C. office. And Kevin Kloss, a director in our Dallas office. Our presenters will speak to lessons learned, common pitfalls we've seen with our clients, and share some tactical steps you can take to best position your company. Before we begin, just a few key housekeeping reminders. All past and future webinars can be found on our website, riveron.com. In order to obtain CPE credit for your participation today, please make sure you answer all 4 polling questions. If you do have a question during the presentation, just utilize the Zoom Q&A feature. And if we're unable to address your question live, we'll do our best to provide an answer via chat. Following the presentation, a webinar evaluation form and CPE certificate will be emailed to you. Let us know if you have any questions. Hopefully everyone can hear us okay. All right, let's go ahead and get started. As we hold this webinar today, there's an increasing list of business risks and disruptors to really complement those stemming from COVID that we're already doing our best to manage. The dynamic situation in Ukraine and Russia, with its far-reaching impacts to energy prices, Asian manufacturing transportation, and a potential spark for wider sanctions on key supplier nations. On top of all that, we're also seeing increased concerns on inflation, labor market scarcity, and costs, and so on. This is firmly placing cash management at the top of every CFO's priority list. We'll walk through the latest in what we're seeing in terms of known and potential disruptors in the wider environment, and then we'll focus on key areas that every finance leader should be evaluating as the need to optimize cash management increases. Before jumping into the content, let's start off our discussion today with the first polling question. Where does working capital optimization currently sit on your priority list? As we wait for everyone to answer, Oscar, Greg, Q4 and Q1 seem almost years apart. What are the implications from the latest Purchasing Managers Index, or PMI? What will this mean for those of us focused on getting the most out of our working capital?
It's a good question, MB. I'm glad you asked. So PMI and the analysis that goes into it is often a solid barometer, one of many, for macroeconomic planning. There's definitely been a change from the last 2 quarters in 21 to February's this year. It has dropped significantly, signaling a contraction in spending. Related to the topic of working capital optimization, PMI should be used. It's one of should be used as a key input as part of the company's planning process in support of not only inventory but also purchasing decisions. It's, as I mentioned earlier, it's one of many indices used as an input to their planning, budgeting, and forecasting processes. We also keep our eye on production / growth and then demand trends also. How did we do on our polling question? There we go. Not surprising.
Kind of split here.
Yeah. It's at an all-time high. And people have plussed up on their liquidity as well. So that's good news. All right. Well, let's take a look at some of those other trends that I was mentioning earlier. So as we look broadly speaking across several economies, I think as we look at their GDP, growth is slumped into 22. I think it's a 1.5 year low at the starting in January. And it's attributed primarily to the Omicron wave disruptions. And while it did hit the developed world, the emerging markets fared much worse. They were seeing since the first time in August of 21, they were actually seeing production or manufacturing output contract. And against all this, to make matters even more interesting, there's now worsening price pressures, but central banks around the world have begun to adopt more hawkish tones. And we're seeing now the Fed also talking about and executing some tightening. So leadership teams continue to evaluate all of these elements driving all of these trends and economic developments as they think about and consider their improvements and investments made to date to mitigate the risk of Omicron, and they're thinking through what else they need to do to address the multitude of emerging challenges kind of mentioned above. What do they need to reassess? So the resurging pandemic has shut down in China, has ports clogged again. The shutdowns elsewhere begin to affect the supply of key components and finished products. We're seeing rising energy prices. Onshoring and supplier diversification is in progress, but that's not necessarily a near-term answer. It'll take several years to be realized. The raw materials and components supplied now by Russia, Ukraine, and China, we're seeing an immediate impact, and scarcity is going to continue to drive increased demand and price pressure. So what does that mean? That means for those that aren't necessarily paying attention to the external factors, they're going to begin to do so more and more, but also we're seeing more collaboration across not only finance and those tasked with planning, budgeting, and forecasting, but also those tasked with sales and operations planning, the folks that are responsible for creating an accurate forecast to level loading production onto manufacturing assets, and for those responsible for replenishment planning for the critical supplies. Greg, how are you seeing executives adjust to these new sets of headwinds as they emerge?
Yeah, thanks, Oscar. Certainly thinking about the executive sentiment and some of the headwinds that we're seeing in the market, certainly all of these items are putting a spotlight on working capital and having companies rethink what they need to be doing to optimize working capital. I think we have all been feeling the pain. If we can, Craig, move to the next slide, please. I think we have all been feeling the pain from things like the recent supply chain disruptions, labor shortages, and certainly demand increases for some of those raw materials. And now we're starting to face more emerging pressure. from things like increasing inflation, the global instability, as a result of the emerging supply constraints driven by that global instability. These headwinds are putting a greater focus on working capital and the need to be able to tap new and creative sources of capital. Our view is that unlocking cash from your working capital cycle is likely the lowest cost of sustainable capital that you will find these days. And to support that, let me point to a few interesting third-party stats that we came across. Almost 60% of executives expect their liquidity needs to increase through Q1 of next year. And at least half of executives will make optimizing working capital a top priority in 2022. I know, and I think the others, my colleagues on the line here will testify to this. We feel that many more executives have working capital management on the priority list, regardless if it is the top priority or not. So, I mean, let's balance the message here a bit. Certainly there are challenges, but with that come opportunities. For clients that we are working with to help optimize working capital, we're seeing a lot of benefits. We're seeing them be able to reduce their debt load and avoid a higher cost of debt. We're seeing them able to reinvest in the business, including deploying digital enablers and optimizing inventory levels given the past and expected supply disruptions. We also see companies upskilling their current workforce given the labor shortages. So there's been a reinvestment in talent and people, recognizing that that is the easiest and cheapest way to avoid some of the labor challenges. And the overarching benefit to all of these is an increase in valuation and more efficient operations. MV, I'd love to hear a bit from the audience on what external influencers are impacting their business.
Okay, great. Here's our second polling question, everyone. While we wait for everyone to respond, Adam, I've heard varying perspectives from buyers and sellers on the value of working capital. How is that different from the focus we're seeing with our clients?
Well, thanks, MV. You know, it's really two very different perspectives for two different types of client initiatives, that being, you know, our transaction type clients and then our performance improvement clients. So I would say for on M&A engagements, buyers and sellers tend to look at working capital in the aggregate and then try to use it as a value extraction mechanism at closing, probably to a greater extent than really what it's intended for. So in short, you know, they'll look at it as an indicator of potential value related to the acquisition asking price, versus I think on our business performance improvement clients, you know, Kevin, how do you see them looking at working capital maybe a bit differently than our transaction clients?
No, thanks, Adam. I think there's usually two spectrums that people fall on, and of course it's suited to the business itself, its industry segment, and where they may be in their current cash positions. But a segment of our clients with the highest priority on cash flow and creating a predictable cash flow to cover debt obligations and be able to operate their business. So they may do things like lower inventory levels, or really popular things, extending payment terms. Other clients, their primary focus is on profitability, and they focus on how to improve their P&L positions from cycle time reductions, waste reductions, and such. But ultimately, both of them start to get to a balance between cash flow and having free cash flow cover operations and profitability.
All right. Looks like there are a lot of external influences affecting cash flow here, with the winner being supply chain disruption and labor cost scarcity.
Thanks, MV. When I think about some things that can be used externally to help look at a business, it's benchmarking. And when I think of benchmarking, there's two thoughts that come to my mind. Number one, what is measured is what is important. And then number two is things aren't always as they appear to be. So I think benchmarks are a great tool to give a scan of the art of the possible, but there has to be some evaluation of what that means, because outperforming the benchmark doesn't mean your organization is performing optimally, and underperforming the benchmark may suggest unrealistic targets for a specific situation. So benchmarks are great to identify areas to go into deeper discovery and move beyond industry KPIs. And that's evaluating things such as internal structure, policies, process, tools, data fidelity and access, and finally, functional alignment with the organization that identifies opportunities, executes controls, and also executes any improvement plans. Adam, can you think of an example where benchmarks led a leadership team to go down the wrong path or unrealistic expectations were created?
Yeah, thanks, Kevin. I think probably many leadership teams have experienced, maybe some beyond aspirational targets, especially when it comes to things like DSO and what can really be done short term with working capital. So, not long ago, we were working with a leadership team that was under a lot of pressure to produce some really quick results against what I would say an almost unattainable working cap target. And the default plan of attack is in many cases, they were throwing a lot of folks at aging AR, basically because that was the one thing they could find, but it wasn't going to get them anywhere close to this aspirational, target that was based on some research the investment partners had done with some other benchmarking companies. So it just really became clear very quickly that there was a little bit of emperor's new clothes going on. Nobody really wanted to talk about the fact that that was the wrong benchmark to use. They just kept on, doing whatever they could to achieve what they could, but knowing they were never really going to get close, but didn't really know how they were going to push back against that. I think what we ended up finding was that as we got a little bit deeper and had them go beyond some of the industry benchmarks, we worked with them to get much more granular, looking at customer segments and product level profitability, and understanding kind of for those customer segments, what were the needle movers in terms of how you could impact working capital, right? So, in one case for larger clients, it was, pushing to get onto EDI, invoice transmission and payment. For smaller clients, it was sometimes just about picking up a phone and making a call to remind them that their payment was due. So I think by getting down deeper into the data, which is really the whole point of, I think, our perspective on revised or rethinking benchmarks, I think long gone are the days of being able to look, in history and use that data to help support current or future targets. This is all about getting deeper, real-time access to what's happening in your organization and then being able to act upon it. And I think that brings us to our next subject, Kevin, which is, even after you have this data, how do you start to shift towards what we would call like an activist working capital organization, to use that information to actually execute change?
Yeah, that's an important aspect. If you don't act upon things, it doesn't really matter what the information shares with you. And it reminds me of one of my clients that was experienced double-digit growth and was burning through cash and really wasn't clear on what was driving it. So the technique we took was we looked at their value chain and actually put the dollars associated with various aspects of the value chain: purchase commitments, raw material inventory, WIP, finished goods in the factory, finished goods in transit, and finished goods at the DC. And this visual helped break down the information silos and allowed the executive team to start to observe three major things. Within their finished goods, there was a significant amount of slow-moving inventory. While within their transit, they had a lot of days in transit. So they had the logistics VP start looking at different routing opportunities to reduce the number of days. And then finally in operations, they had some yield issues, which quickly identified a corrective action and a timeline for it. Ultimately, the information triggered action plans, and the action plans resulted in some sales promotions as well as some operational improvements. Adam, from your perspective and seeing things on the financial operations side, what do you typically see as organizational friction that consistently drags on working capital?
Yeah, so my all-time favorite, or I think usually the first place I look, is what I would consider the invoice generation cycle, or looking at your unbilled, because I think it really pulls together a lot of the items you're seeing on the screen here in terms of the functional touch points, the kind of confluence of processes and data and other things that really will stress an organization's structure and maturity just as much as it will their systems and data, right? And I think that's kind of the whole point of an activist organization, is saying, hey, look, we can invest a lot in systems and everything else, but is our organization ready to execute that? Do we have the reporting procedures and processes in place? Do we have accountability? So I find all those things often come together at invoice generation. And I think one of the other reasons I really like that is it's a great stepping off point for most companies, because the company holds all the cards in that part of the process, right? They own the ability to influence and change the way that process works and is executed. So I think, when we think about why maturity is so important, and I think we'll look at this as we move forward in just a second here about talking about a more formal blueprint, but it's not just the targets, it's also making sure that your company is set up, or that you are preparing to set it up to have the right structure to enable and act upon the change. And I think one of the first things we typically see beyond maybe the invoice generation process is we'll always use kind of any sort of established SNOP process or lack thereof as a litmus for whether or not companies are conducting the more kind of operational activities that are going to eventually enable the success that they're looking for with working cap. So I think I think that's the topic of our next polling question, MV, is around how many of our folks today are maybe already engaged in or working with a formal sales and operations planning process. So if we go to that question.
Great.
Yep. There you go.
Thanks, Adam. Everyone, polling question number 3. How would you best describe your organization's SNOP process? And while everyone's answering, I'll turn to Greg and Oscar for a related question. What is the real difference between FP&A and sales and operations planning?
That's a good question.
Yeah, it is. Thanks, MV. The role of, I'll start, and Oscar, please support. I mean, the role of FP&A varies widely from company to company, but generally speaking, FP&A is primarily responsible for enterprise-wide budgeting and forecasting. The higher performing FP&A function is also serving as a business partner and bringing business insight regarding the performance of the business. Although FP&A takes an enterprise-wide view, it is related to SNOP. It is important for the lines between FP&A and SNOP to be blurred, and those processes to be synced up and working in an integrated way. The output of an SNOP process is a very important input to overall enterprise-wide planning, budgeting, and forecasting. And so, Oscar, I'll let you expand from here on the SNOP front.
Yeah, I would say, thanks, Greg. In addition to collaborating across greater visibility and more detail across the planning, budgeting, and forecasting discussions, there's been kind of a shift, right, from what sort of planning must be done? What sort of decisions need to be made to what sort of actions can we be taking near term to protect our cash and enable our cash management? And so as far as SNOP is concerned, it's a logical extension taking you into business planning and execution discussions tied to sales and their forecast. What are they seeing from the market? The related demand plans for operations, manufacturing, assembly teams. And then of course, the supply plans that support supply replenishment to determine what the optimal total landed cost of supporting that customer demand could or should be. And so while they're distinct, we're seeing more finance FP&A teams coordinate with the traditional SNOP teams. But I would also say that we're also seeing finance play much more of a role in our SNOP type of discussions as well. Did that answer your question, MV?
Yes, that's great.
So perhaps
our poll results.
Yeah, let's talk about those.
Yeah, and I think, Adam, pivoting to Adam, we've discussed more accurate ways to establish working capital targets and the value of critically assessing readiness, alignment, but there's a lot to consider. How can companies move from the conceptual to the more commencement and really start delivering results?
Yeah, thanks, Ivy. I think, that polling result was actually really interesting. I was actually surprised to see how many, what is SIOP did we get, or what is SNOP? So, I think that kind of lends itself as a nice segue into the discussion around what a blueprint is, or the way I think we think about a working capital blueprint, because without an established SNOP process, that would kind of be the dipping your toe in the water for having some sort of formal combination of something like, I'd say, a charter or a future state design for how you're going to go about getting at working capital improvement, right? So the way I think about a blueprint, it's kind of like, you better know what your itinerary is before you start packing your bags for your trip, right? And I think that's the purpose of this, is it provides the future state framework for the org structure, critical processes, systems, tools that are going to support not only like short-term kind of rapid fire quick wins, but also really setting the stage for long-term and sustainable working cap improvement. So I think in a nutshell, a blueprint, these were actually, for me personally, were born out of IT engagements, which, you'd have a lot of clients that would implement a new system and only find out once the consultants were packing their bags to leave that they didn't have somebody there to take it over, right? Because they never thought about that in their future state design. So the way I look at a blueprint is it just provides a formal plan that is going to define cross-functional goals and objectives. And we talked about that already, Oscar and Greg did, around FP&A and operations and how important that is. It establishes your operating and service delivery models. It identifies supporting technology. It creates the appropriate KPIs and reporting so that everybody's on the same page about what those are. And it begins kind of infusing business process standards. So I think a lot of times that I've worked with clients, they're like, you know what, I'm already kind of in flight with some of these. There's no reason to go back and do all this because I'm kind of already in up to my neck. And I would argue that whether it's beginning or mid-flight, it is a really important activity to undertake to kind of level set with everybody. I think, Kevin, to that end, I've seen a lot of different clients that have embraced this and have not, and I can tell you that there's a pretty relevant outcome to those things. But have you been with any clients where you've seen them use or not use this, and kind of what the risks or advantages were?
Yeah, I have. I'm going to say failure to plan is a plan for failure. And what you talked about on the blueprinting process that really jumps out at me is every leadership team is in a stage. Not very often do you find companies that everybody in every leadership position has been there for a while. So they naturally go through their storming, norming, forming, and finally performing phases. And the blueprint process allows them to do that. If they don't, the most common outcomes, and they're pretty predictable, are they're going to miss key requirements. They could alienate stakeholders. And if you do those things, you're pretty committed to having your cost projections be incorrect because you've missed something and potentially underestimating resource constraints. That blueprinting process, while nobody expects the plan to be executed as it was written, it provides an opportunity for everyone to get their hands on it and become a part of it versus apart from it. So I found that companies that don't do it, they tend to not perform at the same level they want to be. It takes a lot longer to get there. And, you know, when I think of it, now that we've talked about the importance of establishing the appropriate targets and ensuring the organization is prepared to support the change, and created a high detailed future state blueprint required to support the activities, there's some reoccurring challenges or needle moving opportunities that we have to really focus on next. And that kind of goes, after you do the blueprint, what's next?
Well, so I think that's probably why most of the folks probably wanted to listen to us today. I think I think it's how do we start to really get at, you know, the meat of this issue and start making improvement. And I think from looking across a variety of clients, the opportunities to really make meaningful improvement to working capital typically fall into three main buckets. One is going to be your order to cash cycle. One's going to be within integrated SNOP. And then another big bucket is inventory management and effectively managing that. So, you know, rather than me talk through those things, you know, Greg, given that you've helped a lot of clients, especially in the order to cash process, what kind of success story or what kind of needle movers do you typically see within the confines of O2C?
Yeah, thanks, Adam. And to kick this off a bit, I want to refer back to that Venn diagram that we highlighted on the previous slide, where we had finance, supply chain and ops, and sales. I think success is driven, and we don't need to go back, but success is driven when clients organize and execute in an integrated way. Often some of the gaps and pitfalls we see is when clients try to solve a working capital problem, focusing just on finance or just on supply chain. This is truly an integrated opportunity where we need key stakeholders from those various areas involved. And on order to cash, related to order to cash, you know, obviously it's essential to managing day sales outstanding and getting cash in the door as quickly as possible. Challenges within the order to cash cycle can manifest themselves in a number of ways, including how are orders captured, the ability to get invoices out quickly and accurately, and transparency into outstanding receivables. One example, and we've heard back to some of our transaction type clients and projects. We have one client who has grown quite significantly inorganically, to the tune of executing multiple acquisitions a year over the past several years. And to avoid, and I'm sure there's many out there who are in this position given the volume of deal activity that is occurring these days. And so with this particular situation, to avoid any customer facing disruptions, a deliberate decision was made to maintain legacy processes across their order to cash cycle, resulting in a proliferation of ways the company captured orders, submitted invoices. It also meant that there was a lot of variation in customer payment terms. So what was the impact? The primary impact was it made it much more difficult for leaders, both management and the board of directors and their supporting staff, to forecast cash, track receivables, and as a result, DSO ballooned. And we played a role in supporting this client with trying to balance a couple of key priorities. The first was back to the original decision that they made around minimizing customer-facing disruptions. We didn't want to come and introduce a lot of customer-facing disruption. So the challenge was, how do we balance that with creating a standardized set of processes and technologies to not only reduce the manual burden on the team faced with this proliferation of ways that the company was working, but also increase their ability to forecast cash and ultimately reduce DSO back to a more reasonable level. So it's clear that working capital can be impacted in a lot of ways, and order to cash can be largely the brunt of that impact. In this situation, it was a high growth environment and deliberate decisions around an integration philosophy. Ultimately, again, the goal was, how do we bring DSO back to a more reasonable level so that cash can be injected back into the business and support future acquisition activity. Kevin, I'll kick it to you to talk a bit about some of your stories and lessons learned on the sales and operations planning side.
Thanks, Greg. I'd like to start out by saying, when I think of S&OP, I like to make it as simple as possible. S&OP is a forum to have discussions around the business. So when we talk about various components of it, it's intended and designed to get everybody aligned so that a group decision can be made for what's best for the organization and everybody follow through on it. So when I think of how SIOP can really impact working capital, part of it is, what is the forecast and demand plan? How accurate is it? Are there new customers coming in? Are there any activities that need to be done to prepare for new product launches? And then it's discussion of, how do you fulfill that? And I've seen S&OP discussions start to focus businesses on, what are my hard margin products and what are my biggest, most important customers, to make sure their needs are fulfilled. So I've seen an organization have to make the hard decision of not doing overtime or trying to get a contract manufacturer to make some dental hypodermic needles, but rather they were going to use that capacity and allow some of the dental sales to be lost to fulfill veterinary hypodermic needles, which was much higher margin and they had much bigger clients for. In today's day and age, you've seen a lot of manufacturing companies have experienced with supply disruptions, and consequently have had to look at their product portfolio and understand what the profitability is by product, and even rationalize some of the SKUs that they offer. And this, again, is a key opportunity to be discussed in the SIOP process. And then several companies I've worked with over the summer, they ended up having such large growth. They were going double-digit growth year over year, having 30% increase in order size, and they ended up getting behind on their production capabilities. So they started to allocate material based on customer segmentation. So they filled the A customers first, then the B customers. And what they did is, to fulfill C customers, if it was a make stock product that they had, they increased the production quantity so they could fill some of those orders partially and get the revenue for it. And, finally, some of the conversations that can come up in an integrated S&OP conversation is, should we be raising prices? Inflation has been occurring. Supply disruptions have caused higher costs in manufacturing. Are there opportunities to increase pricing? And does that pricing come through direct as a unit cost increase? Or do you look at changing your packaging configurations to have something that more suitable and cheaper to produce for manufacturing, so that you can not only increase the revenue, you can also reduce the level of effort in your manufacturing areas to support those commercial and customer objectives.
Yeah.
Now, S&OP often impacts inventory management. And Oscar, I'm sure you have some examples on how companies really get a laser focus on how to improve their inventory.
Oh, yeah. Well, S&OP can affect a lot of things, just like you were talking about. It can affect pricing. It can affect recategorization of SKUs and products, and definitely inventory as well, or the lack of inventory management. And I think so many times, especially in some of the larger organizations, some of our larger clients, I'm thinking of one in the oil and gas space that was focused on offshore exploration production projects. You know, they operate these platforms and drill ships, and they run at about $1 million a day to keep going to go find and extract hydrocarbons. And so having downtime due to critical spares was a big no-no, because it was an enormous waste of money. And so for a host of reasons, mostly tied to non-standard item master data, the planners and engineers that were contributing and working through these projects had created an unintended pool of excess inventory within their shore bases. They didn't have the visibility into the reusability of what they were ordering for each of these projects. So as they would move from project to project, rather than using the unused excess spares beyond 2 or 3, whatever that level was, they would just start over and buy again. Every time they would ramp up for another exploratory well, they went through this exercise, and they would ignore the leftovers. And it was largely because, well, it was a host of reasons. The organization, the operating model, every 3 years, it was everyone was on rotation. So every 3 years, there would be a new turnover of executives and program managers and engineers and planners. And so they kind of kicked the can down the road. It didn't really become an issue until it was. And when things began to get tight, they began to revisit areas within their project space where they could conserve cash or capital. So we went and revisited the shore base with a drilling engineer. We found all of the aged inventory, and quite a bit of it could be repurposed as critical spares for targeted upcoming projects that were yet to be funded. And so once we did this, it was an amazing exercise, because it wasn't necessarily they weren't intentionally managing their project inventory. They didn't consume any of the spares, and they didn't have a plan to deal with any of the leftover or slow moving portions of their inventory. And so we were able to identify several $100 million in working capital preservation, right, or avoidance, let's say, just through providing better visibility into what was reusable and on hand. It was an interesting exercise, but I think it tied to the requirement for people and organizations to think broadly about the preservation of cash and capital at every aspect and for every portion of their business. These were probably some of the smartest people in the world, recruited from top programs internationally, that were phenomenal at putting the latest and greatest technology down a hole into the earth to extract hydrocarbons. And yet they were not as efficient or effective at managing excess or slow moving inventory. And when we turned the lights on into what was reusable here and how they could better manage their inventory just through providing better visibility, connecting the dots, and having this type of reusable discussion, it was a game changer for them. And so they began to invest in not only streamlining how they were planning and executing their EMP projects, but also revisiting, this was just a shore base in the Gulf of Mexico, revisiting visibility into and improving visibility into their slow moving portions of inventory, but also the reusability as well. So we've covered a lot. Or some areas, I think, where you could begin to assess the different levers to pull as you address optimizing working capital. And I think, Adam, you teed up previously the blueprint. Can you kind of talk us through how you pull from that blueprint into kind of a more actionable plan and what we should be our leaders should be considering?
Yeah, absolutely. I agree. We've covered a lot today. And I think just selfishly, as you guys were talking about those last three examples, I have a deep love of digital transformation. And I always like to kind of pick those parts out in each of those examples to see, really from a wider perspective, there's just so much opportunity within working capital. And I think a lot of it does relate back to systems. I just also want to share with our audience that, it doesn't have to necessarily be a daunting term. And as we kind of look at how you put this into action in the next minute here too, I was just sharing with Kevin a little bit earlier that, a lot of the work I've done in kind of doing quote unquote digital transformation is working with leadership teams just to see all the modules of their existing systems they're paying for that are turned off, right? I mean, so I think a lot of times this whole idea, it seems really daunting and scary, but in reality, it's like, well, how do you take step one? Well, we have a procurement module that's been turned off, and we should probably start doing requisitions and POs. I mean, and that's real life story. So I think, the way I look at this is, let's take kind of a quick step back and look what we've talked about today. So we've talked about, not only why is working capital probably, if it's not at the top of your list, it should be pretty darn close right now, just given a whole lot of current and potential disruptors and impacts. So I think the way we started talking about this was, okay, now that I know that that's the case, where am I, right? And where should I be? And that first off is from I'd say a metrics or KPIs perspective, and going deeper than just the industry metrics and looking what really matters to your business. And that's where the opportunities are really going to be found, by getting that deeper visibility. Once I understand that, is my organization set up to handle this? Are we doing some of the blocking and tackling that every company should be doing, that I now can look at that data and do something about it, instead of, just throwing an audacious target on the board and telling people to scurry after it? So I think that's where we covered through, kind of the activist working capital organization, which then leads into the blueprint itself, which is, the combination of the operating and service delivery, the controls, the data, the tech that are going to be required to support not only existing, but many upcoming activities that we, that are illuminated as we go through the processes that Greg and Oscar and Kevin just spoke to, in terms of really getting at what I call crunchy opportunities. And once you've got the blueprint set, you've got a list of detailed actions, or maybe friction points and that kind of thing. I think the final part of this is pulling all that together and into the real tactical execution playbook, which the final steps, once you have all that done, are you've got to come up with a common way of scoring. I mean, to eliminate bias or friction within your workforce. So looking at all those things, putting some standard scoring metrics around them. That can be working capital, it can be time to deliver, it can be EBITDA, right? A lot of these have tangential opportunities to them. So that's what you're kind of seeing on the screen here, is just an example of, I think we fed in a couple real life activities we've worked on with clients. And these are pretty accurate in terms of the way they ranked as we look through it. And the ROIs that you're seeing there are actually, redacted names, but those are real numbers. So I think once you get into that, it's what can you as a leadership team do to start taking action right away with your workforce? And part of that is, looking at value stream mapping activities, doing friction workshops, I like to call them, instead of, process design workshops anymore, but, and then getting some key information together to start laying out your business plans. And that's your workforce census and your transaction analysis, hoping that you have it. And I think once you have all that together, this is a living document, right? But you now have a prioritized, well understood set of specific initiatives with owners, time to delivery, and expected outcomes. That obviously things will add and drop from this list, but that is how you start to get at working capital, because there is no one wand you wave at this, right? It is many, many micro projects that you have to constantly be looking out for. So with that, I think MV, we've hopefully caught everybody up to speed on the content today, but I believe we have one more polling question left, and then we can probably move towards opening up to a wider set of questions.
Yes,
Yeah, and
thanks, Adam.
as we step into that final polling question, let me take a moment to just let's sum it all up. So there was a lot covered today, and to tie it all together, certainly we are seeing significant headwinds, and as Oscar alluded to, some deteriorating macroeconomic conditions. As a result, a renewed focus on working capital management, and as you can see on the page here, some ways to drive some significant value. Three major focus areas that we touched on that we think can support your organization in realizing that value as it relates to focusing on the order to cash cycle, rethinking how you do sales and operation planning, and then embedding more disciplined and transparent inventory management. And then lastly, as it relates to the tactical playbook here, approaching this in your organization in an integrated way. This is not a siloed effort. So bringing to the table finance, sales, and certainly supply chain and operations to help realize that value. So we appreciate all your participation, and hopefully you found our information and perspective useful. And with that, MV, let's now go to our final polling question.
Great. Thanks, Greg, for really connecting the dots there. And I think we'd all like to know what the greatest value unlock is in our respective organizations. And while we give everyone plenty of time to answer on our final polling question here for CPE credit, I'll hit our panelists with a few lightning round questions. Kevin, is the shift to just in case from just in time going to continue through 2022? Or do you think inventory levels will continue to increase and add much needed cushion to the supply chain?
I think the need for just in case will continue. I think the inventories will probably be a little bit more of a mixed bag, but ultimately people will still be trying to buy things in order for them to support their customers.
Thanks, Kevin. And Greg, where have you seen most investment on your clients' working capital agenda? In visibility or digitization?
Yeah, definitely digitization. It's a major focus area.
Definitely. Oscar, I know what we're all thinking. Do you think we've seen oil hit its peak price per barrel?
Yeah, I think it depends on on the activity that is happening between Russia and Ukraine right now, clearly. But I think it continues to rise.
And finally, Adam, will the labor shortage abate by 2023, or will we continue to see a premium for talent?
I think it's pretty clear. I think we're going to probably see a continued increase in the cost of human capital and just overall scarcity, right? So I think it's going to certainly continue into 2023.
How did we end up
Great.
with
You're all-
the automation? There you go. I like it.
Ditto.
Completely agree with that. I mean, the degree to which people are investing in technology like RPA, robotic process automation, better visibility and streamlining the payables process, receivable process, inventory management, all of these manual processes, digitizing and automating them has unlocked, and we've seen this time and time again, unlocked real working capital improvements across the board. Cross-functional alignment too. It's another solid, well, it's a third actually, beyond improving real-time analysis and reporting. So again, it's all along the kind of the same theme. We agree. Glad to have that reinforced.
Yeah, and Oscar, I think for me, what those answers speak to is they all contribute to sustainable improvement, right? And I think it's always been kind of the tough thing with working capital is a lot of times it's a whack-a-mole, right? It's just by its nature, it's always changing and flexing. But by looking at kind of the cross-functional collaboration and implementing and instilling digital tools that guide and govern that, you get that sustainable improvement, right? So
Yeah,
very
agreed.
All right, well, we're kind of running up on time here, but if anyone has any questions, feel free to use the Q&A function and we can always send you a response later if we are unable to answer. Just want to let everyone know as we kind of wrap up, thanks for joining us, and a recording of this webinar will be uploaded on our website. There you can also find these other insights listed, really showcasing the different expertise we have within the firm. And thank you so much. You should receive your certificate via email in the coming days.